What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 5th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's Macro Monday, I want to spend some time to step back and really try to get a macro perspective as to where we are within the bear market for cryptocurrencies. As we've been slowly ticking up here over the last 3 weeks, many people are yet again wondering if we've finally hit the bottom. And I want to go ahead and turn to price action as well as the fundamental reality of where we are within crypto to try to get a decent understanding as to where we are. If you like this video, consider dropping a like, and let's go ahead and kick off the rambling. So I want to go ahead and just emphasize the topic of price, because I know a lot of people have different perspectives about how long the bear market will be, how brutal it will be. Generally speaking, we don't want to ask when the lows are going to come in. No one knows when that's going to happen. What we'd really like to think about here, if we're trying to play it smart, is whether or not price is showcasing that the trend is in, that we are starting to move higher. And so far, price action is still incredibly lackluster. Even after 3 green weekly candles here, we're only up about, roughly speaking, 5-6% for the last 3 weeks from the initial open back on November 21st. So it's been a pretty lackluster recovery here, and much weaker than the previous rally that we had back during July, where we had some major wicks in regards to price, where we started to see on a given week moves of 8%, almost topping up towards around 10%. So far, we've been seeing pretty lackluster performance from Bitcoin. But if we go from the complete opposite spectrum of asset classes, from Bitcoin being very high risk to the least risky assets, we can start to see the Dow Jones setting up its highest price level since back in April of 2022. The high dividend paying stocks, the defensive plays, those who are providing consumer cyclical products, those that are going to survive no matter if we are in a bull or bear market to some degree and be able to provide some kind of corporate earnings most likely. These are the companies that are doing really well right now. And it showcases that yet again, another repetitive sign, the price is telling us we are still in a bear market. Investors, if they are taking any capital that they have, are putting it towards defensive plays, not risk on plays. And for me, as a swing trader who loves looking for momentum, I'm not seeing the momentum in the risk-on assets. I'm seeing people run towards defense. I'm seeing people working towards preserving their capital. And as a macro trader, this is the biggest red flag, not only not to invest in the defensive plays, because as we've talked about here, this is a very, very similar pattern in the Dow Jones. If we go back to 2000, I'm just going to pull up the chart here, bring it back to the first 2000, we can see that there are many times where we saw the Dow Jones get above that 200-day moving average, coming very close to the highs, having many relief rallies, yet again setting in new lows for years to come from the peak of the dot-com bubble in 2000 all the way into 2003. You do not want to get caught in the chop of this and lose more money than you possibly already have. It's about being disciplined and preserving your capital. And we're seeing the exact same signs here in the NASDAQ, whereas the Dow Jones is setting in highs against April of this year. The NASDAQ is barely, by a thread, trying to grasp onto the 200-week moving average rather than pressing the button against the 200-day moving average. This is again repeated through Ethereum, as we're down below the 200-week moving average still, even though Ethereum has been holding up stronger than Bitcoin. And I want to go ahead and bring up 2 really critical points here. We not only can observe this through price action, but we can also observe it through market order flow. If we take a look at Multibook, which is trying to get a good reading of the trading activity through the broader market, this is one of the exclusive features and tools from our partner Bookmap that gives us deeper insights into what the market is actually doing. We can see that we're down minus 9,500 on the cumulative volume delta, i.e. market order flow is negative. It's a fancy way of saying that more people are taking the best available price to sell Bitcoin than taking the next best available price to buy Bitcoin. There is more demand for outflows. And while there's always going to be someone on either side of the trade, the more eager side is the seller, not the buyer. And that's a clear sign that we are still likely, as we've been watching this each and every Macro Monday, it is a clear sign that there is still capitulation, there are still market participants leaving more than they're coming in. Now, another thing I think that would maybe kind of put this in perspective here, similar to how we've been seeing Bitcoin versus the Dow Jones, really underperforming with where it's at, right? Again, the Dow Jones pressing above, well above that 200-day moving average. Bitcoin still well below not only its 200-day, but its 200-week moving average, a first in its history to sustain this long below the 200-week. Usually we see a small bump below that 200-week. But again, a really important thing I think we can learn from history is the 2000s, the dot-com bubble, when we had a huge collapse of a lot of unprofitable technology companies that were highly overvalued. And while we don't have those IPOs that went to zero, hence why I'm really cautious about being exposed in a lot of the overvalued layer one plays like Solana, you name it. It's all the types of different plays out there that had so much artificial value, right? While we don't have those dot-com bubbles those dot-com bubble companies that went to zero, we do have Amazon and Microsoft, two companies that were probably some of the more sound fundamental companies during the dot-com bubble and survived here to this day. And just trying to grasp how bad they performed during the dot-com bubble after leading the way during the bull market. We can see that throughout the entire bear market, Amazon did not once touch against the 200-day until it finally started to recover in 2002, all the way up back to $2.70. Yet again, however, not coming up to reclaim new highs as far as 2009. To put that in perspective here, right, if Bitcoin were to do something similar, we're looking into practically the late 2020s, right, 2027, right, before we'd actually see something exciting happening, where we'd get back to those previous all-time highs. Again, that's not only to talk about how long it can take to reclaim all-time highs after extended bear markets, but on top of that, we need to understand that it can get much worse. These companies went down over 95% in the case of Amazon. Let's take a look at Microsoft. Microsoft down 66%, one of the more established and steady companies that have been around for a much longer period of time, had much more established revenues and market dominance, still throughout the entire bull market, barely coming up to test against that 200-day and getting shot down every single time, yet again setting in new lows. It takes multiple waves of relief rallies during bear markets to get us down to the lows, the capitulative lows, where the bids are going to come in and provide that support. And that's the exact same case here with Bitcoin as it is with Ethereum. You may like it fundamentally, you might like these protocols, you might have an altcoin that has the next big idea. Doesn't matter. If the capital flows aren't there, price is going to continue to move lower. This is why I really emphasized, while we here on the channel are very big on altcoins, we love riding the altcoin waves. That's where you can make some really big generational returns. It is important to understand that we need to be passive and understand that it is the right time. When it is the right time, that is the moment to strike on altcoins. It's not just best to dollar cost average in these plays, because it's not only high risk, but on top of that, you need to see which ones continuously build and survive and have the funding to be able to prosper during the next bull market. One of those plays that we're keeping an eye on big time, and it's been one of our long-term partners here on the channel, is Integral. Now, if you guys haven't heard about Integral, their key product size is a widespread decentralized exchange that allows you to do large-scale volumes from one crypto asset to another. Now, you guys know that we've talked about over-the-counter markets, or OTC for short, and this is a huge area of the cryptocurrency space, for example, that still to this day is run through centralized counterparties. You're still going through some centralized third party to be able to match trader A and trader B between one given asset to another. And these large volumes are massive, sometimes up towards millions, if not tens to hundreds of millions of dollars. And still, we have not seen a major DeFi protocol like Uniswap try to tap into this market. Well, Integral has done so, and it's built the size product that allows you to do major tradable volumes. Now, if you guys haven't heard already, again, Integral here has been a sponsor of ours on the channel for a long period of time. We've been talking about the exciting developments that they've been building. And on top of that, there's some huge things they've been developing on layer 2 networks like Arbitrum, continuing to build and deploy during the bear market, getting more market traction. This is the best time to be doing so. And on top of that as well, if you guys really want to learn more about size as a product or see why Integral's time-weighted average price mechanism is much better than, say, the traditional means of trading where you can incur lots of slippage and large volume trades, then I definitely recommend you guys check out the website, read into some of the docs, and learn a little bit more about what the team has to offer and the products that they're building. This is a great example of a project that I'm keeping on my radar. And I'm not saying you guys have to go out and buy Integral right now or anything like that. Again, that might be against my point here. My point is to focus right now on the projects that are building and know when to strike. For us, we are still watching altcoin dominance. We are watching how altcoin dominance, or more specifically the inverse here, which is Bitcoin, Ethereum, USDC, and USDT, basically the major cryptocurrencies and dollar liquidity. We're trying to see how much percentage dominance these plays have in the market. And they're practically about 3/4 of the market now. What we'd like to see before we really start getting optimistic is for those major plays to take up anywhere from around 82 to 90% of market share, similar to the lows we had in December 2020, right before we kicked off that altcoin wave. And while we've got a lot of things going on in the crypto space, it makes me even more hesitant to be making any major moves right now. It's time to focus on getting engaged in those communities of the exciting projects, getting involved where you can, but knowing as well that this market sentiment right now is still really dark. Genesis, one of the big subsidiaries of Digital Currency Group that we already knew was in the hole, seems to have had an even bigger hole than we previously thought. Right now, Genesis has an outstanding loan amount, from what we know, of $1.8 billion after the revelation came out that they owed Gemini customers who utilized Genesis as a backend service to generate yield over $900 million. That's a lot of money. And to be honest, Genesis is already struggling, or was struggling back last week, to try to be able to raise an emergency loan to cover up the billion-dollar hole that they have. The contagion is real, folks, and it is going to continue to have negative effects on this space that are going to set us back easily a year, year and a half. So right now is the time to be building up capital, building on protocols, engaging in communities, and finding the plays that are holding out resilient, the ones that didn't take too much risk during the bull market, that have the capital to be able to survive and be able to build something really genuinely exciting. There will be lots of exciting projects out there. Now, the last thing I want to focus on within the macro perspective, and I know this is why a lot of people have started to get optimistic, people are looking at two of our favorite metrics here on the channel. I know many of you are very well looking at the charts we look at here, and I think that's awesome. You guys should definitely keep these on your TradingView application and your watch lists, and do your own analysis as well outside of just mine. But the key thing that I know a lot of people have asked me about in the Dash Report group is whether or not I've noticed the decline in the dollar as well as the decline in the US 30-year yield. These are typically signs that the Fed is going to pivot, that the Fed is not going to tighten as aggressively as people previously thought. And while I definitely think these are notable declines, and there's a very good chance that the US 30-year yield could come down to that 200-day moving average and that the dollar index could continue to decline a little bit, I have to tell you all, the key thing I'm waiting for here, and I'm happy to pay a slight premium on Bitcoin or pay a slight premium on stocks if it turns out that this is the bottom, that the Fed is ready to come to the rescue. I want to make it very clear that I'm waiting for that December FOMC meeting. Case in point. And I think that a lot of people in the markets, even those who are trading on the dollar or in the bond markets, might be overestimating just how forgiving the Federal Reserve is going to be. And need I remind everyone a very important point, which is that within these general tops, we tend to find not that it's a straight up and down line. We find that there's chop at the top. And it's important to realize that throughout history, we tend to find that the dollar not only will continue to stay suspended during these rallies, but on top of that, inflation is not something that you can easily pivot on. The moment that the Federal Reserve steps back, and again, as we talked about this catch-22, the moment the Fed steps back from its pivoting efforts and doesn't show that it's in the lead, that it's rather going to cater to financial markets, is the exact moment where I start to get worried that everything's going to be reversed back. Inflation will come back, energy prices will soar once again, demand will return. The Federal Reserve needs to cripple demand in the economy. They need to keep inflation suspended below their 2% target for a prolonged period of time. And if they decide to pivot, if they decide to start softening, I can tell you guys, it's not only not going to be good for the broader economy, it's not going to be good for asset prices. That's why, again, this catch-22 leaves me in a position where I'm not really eager to buy anything and just simply sit on the sidelines, build up a cash position, watch the builders, and set my targets for who I'm going to be investing in when things get good again. Anyways, guys, I've rambled on long enough. If you like this video, consider dropping a like, consider subscribing if you haven't already. Feel free to check out Integral down below in the link down below in the description, as well as Bookmap, some more partners here in the channel. But until the next one, everyone, see you all in the next video. Take care, everyone.